I was under the assumption, okay, just make 100 grand a year and I put 60,000 into this property. I thought that came off my total income and I get the tax time. I'm like, what are you talking about? Hey, welcome back everyone to another episode of Eat, Sleep, and Invest. I'm your host, Brian Driscoll, and I'm here with Toby Mathis. What's going on, man?
Hey, doing great. And how are you doing?
Pretty good, thanks. So today's going to be interesting because you're an investor, but you also know a lot about the tax law and the legal side of things. So why don't you give everybody a little background on what you do?
Yeah, so I'm a principal over here at Anderson Business Advisors, about 500 of us. We're a firm that includes attorneys, CPAs, EAs, accountants, and all the administrative staff, kind of a one-stop shop helping people get going as far as asset protection and tax compliance and creating a legacy. Got into this space 25 years ago, and that didn't really hit me. This is one of those things when you're too young and too dumb to figure things out. But I met a gentleman, it was actually in the 80s, not to date myself, but it was about 88, 89, and I met a guy in Washington named Boyd Watkins who was buying foreclosure properties, and he had one of those dot matrix printers where he printed out all these pages of properties that he owned in Seattle and Denver. And my young brain could only think, boy, he's really rich, right? It didn't hit me that he had cash machines, that each one of those things was a cash machine. And he talked about, buying what now everybody calls buy and hold property. But to me, it was just like, oh, he's buying real estate. That's neat. He's buying houses is the way my brain processed that. And it wasn't till about 15 years later. And I'm an attorney and I'm working in this space and working with a lot of investors. And it just kind of backhanded me. And I was like, everything in the tax code is built towards this. And if you do this right, there's a good chance you won't pay any tax. And then even more importantly, your heirs won't pay any tax, and you can access cash out of these things pretty much anytime you want, tax-free. We're literally being led to this as being the best situation from a tax standard, like period. And none of these people really have to work. Once you start building up a good portfolio of real estate, work becomes kind of a decision you volunteer, which is a big difference between being forced to work for a living versus not really having to do it, and you do it because you like it. And boy, that was like an epiphany for me. And that was, I don't know how long ago that was, probably 15 years ago at this point. And since that point, I just really focused in on building real estate. I mean, my partner and I, Clint, we probably were north of 300 properties. We have everything from apartment buildings to mobile home to commercial properties to office buildings, you name it, we probably have it. And we love single family properties, just little, I use bad terms for them, but I'm like crappy properties. I like them. And they're little cash flow machines. And you start to realize, wait a second, I have money coming in whether I do anything or not. I go to Tahiti and spend a month, and it wouldn't bother me in the slightest because I have the income coming in off the properties, and that's a great place to be.
Having a job, needing a job versus doing what you want because you don't need the money, it's a game changer.
Compulsory service, I don't like.
So what kind of things are you seeing in the tax law? Some people might not know about.
Yeah, so let me give you kind of the three types of income, and a lot of people get confused on this. So I'm going to make it really simple. There's stuff you work for, and there's stuff you don't work for. The stuff you work for is sweat of my brow. I'm changing my time for dollars. So I go to a job, or I'm being a contractor. I'm fixing somebody's property up. I'm a real estate agent. I am changing my effort into dollars. And as a result, I get hit with ordinary tax brackets, and I'm getting hit with what's called the Social Security tax. If you're self-employed, they call it the self-employment tax. It's actually old age, disability, and survivors at 12.4% and Medicare at 2.9%. It's 15.3%. Whack. And that's the way I want you to think of it. It's just like a big old whack, just like you're at school and you're misbehaving and a teacher throws an eraser at you, whack, right? You're getting hit with this, and this is actually right there with income taxes, our Social Security taxes as far as revenue for our country. That's how big these taxes are, and nobody ever talks about them. They always say, oh, you're not paying federal income taxes. Well, you're paying a lot in employment taxes, right? And they're about commensurate. You only get hit on that when you're working. Everything else, I don't get hit with that extra tax, that Social Security tax. I avoid it completely. And the two types of income, portfolio income and passive income. And people confuse those all the time. Portfolio income is things like royalties, interest, It's dividends off a qualified stock, which is taxed as long-term capital gains. People didn't know that. And then there's capital gains. Those are all types of portfolio income. They fall underneath that umbrella. None of them you pay Social Security tax on unless you worked and created. Like if I wrote the software program that got me the royalty, then I'm probably paying self-employment tax on it because I changed my time into that money. But if you're just an investor and you're just, hey, I'm getting an interest rate on my savings or on my money market account or whatever, you do not pay Social Security taxes on any of that. If I am investing in real estate, and this is a distinction your listeners will want to know, if I'm an investor and I'm buying for long-term appreciation and for cash flow, I do not pay any Social Security tax. If I flip properties, now they put you in that first category and they say, you are not actually buying as an investor, you are holding inventory, and you're no different than a mini mart. You're buying the Cheerios, putting them on your shelf and selling them, or a car lot, you're buying cars and selling it. And so they whack you with that self-employment tax, which you don't want. And then there's passive income. And passive income, there's only two types. It's rental income, and it's income from businesses in which you do not materially participate. So it's a fancy way of saying being a silent owner in a business. So whenever you see rich people and you wonder why they're entering into different transactions, you might want to be looking at the tax implications, because there's a good chance that they're doing something because it advantages them from a tax standpoint. So for example, if I have rental income coming in and I want to not pay tax on that rental income, there's a couple ways I can do it. I can accelerate my deductions by accelerating the depreciation on that real estate. It's called a cost segregation. And I can use that to offset my rents, which means if I run out of properties to segregate into depreciate, then I need to buy more. So that's why you hear accountants say if you're paying taxes in real estate, it's because you don't own enough, right? You just keep accumulating more. Or you buy businesses and you don't materially participate in them and they kick down losses, and those losses offset your passive income. But here's the big one. Passive losses only offset passive income, period. Full stop, with two exceptions. The two exceptions are if you're an active participant in real estate and you make less than $100,000 a year. It's actually a phase out between 100 and 150 if there's accountants out there. But it's really easy to remember. $100,000 and below, I can write off up to $25,000 of passive losses if I manage the manager. Number two is real estate professional, which is you can get in that rabbit hole. If this is what you do for a living, you're probably a real estate professional. If it's not what you do for a living, then it's probably not, right? But then if you're a real estate professional, your passive losses get unlocked and you can use them against your other income. That's really it. There's three types of income and they kind of interrelate, and you got to understand the distinction. And if you don't, that's when you're usually disappointed during tax season, where you said, well, but I have all this real estate loss. What do you mean I have to pay all this tax on my income? Doesn't it offset? And then your accountant gets to explain to you, well, if you did 1, 2, or 3 things, you could possibly do it, but here's the blah, 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 blah. And all it sounds like is in Peanuts, when they talk to Charlie Brown, you hear that, wah, 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 wah. That's all your accountant sounds like, because you don't understand what the heck they're talking about. This is what they're talking about. They're breaking it into 3 categories, and they're looking and saying, hey, is there a way I can unlock these and use it against other income?
Yeah, you know what? My first property I purchased, I was under the assumption, okay, just make $100,000 a year, and I put $60,000 into this property. I thought that came off my total income, and I get the tax time. I'm like, what are you talking about? They're like, well, no, that roof you put on, you only get the 1/28th of it.
Well, here's the thing. There are some things you can do. You retired an old roof, which means I'm going to take all that depreciation. Accountants don't do it. I don't know what it is about them. You're like, hey, I retired an asset. Whatever was left, whatever I never depreciated, I'm depreciating now, and then I'm putting a new roof on there, then I'm going to write that one off over 27 and a half years. Yep. It's frustrating. But what you just said is, I've seen really sophisticated business people, they'll make $2 or $3 million and they will spend it. And they're looking at things to buy, and they think because I bought something, it's a deduction. It's like, no, it's not how it works. There's this thing called useful life, and the IRS lets you write things off over its useful life, unless there's something like accelerated depreciation that you qualify for. But otherwise, like on a house, a lot of people know it's 27 and a half year property. Well, a good chunk of it is. Can I write that off? If I buy $100,000 house, do I get $100,000 deduction? No. You might not get much deduction at all. You might be surprised that you get a couple $1,000 or something. It's not huge. And then they're really frustrated and they think because I spent it, it's a deduction. It's not how it works.
Right. Yeah. And you want to work with someone through the year so you can kind of prepare and know what's going on too. Because you don't want to find that out on April 15th or whatever the deadline is now.
Yeah, that's a good one. So April 15th is the deadline for filing your tax return unless you extend it. So you always extend. Everybody's like, I always file my tax return on time. Well, why? Like on time is actually October 15th because you get an extension. It's like your teacher says your homework is due on Friday, but it could be the following Wednesday. And you say, well, I want to be on time. I'm going to turn it on Friday. Well, actually, it's not due till the next Wednesday, right? Give yourself that extra time in the tax world. You got to pay your taxes, though, on April 15th. That's what you have a hard stop on is I have to have paid my taxes for 2022 by April 15th of 2023. And just change the years. It's the same rule year after year. So next year, it's going to be got to pay your 2023 taxes by April 15th, 2024, but your return could be due much later.
Okay, now, so you work with a lot of like affluent investors. What type of asset class, like what are the top asset classes and categories that have like the biggest returns and tax, like that help you out on the tax side?
Yeah, great question. And it kind of, I'm going to give you the, it depends. It's the Weasley lawyer answer, right? If they have an appetite for depreciation. So, for example, they have let's say it's you. You probably have a lot of real estate and it's generating passive income for you, which is still taxed as at your ordinary rate, which is 0 to 37% plus your state income tax. So you're like, oh man, this sucks. I don't like it. So you might be looking for things that have a higher value from a deductibility standpoint. So you may be attracted to things like multifamily, maybe commercial projects, maybe you're going into syndications. And you're looking at it going, I'm more interested in the loss that it's going to create than anything else. I don't even need it to cash flow. If all it did was give me a $100,000 loss this year, it's a winner because it's going to save me $37,000, right? That's the way the affluent and the wealthy folks look at it. They're looking at it saying, I made $200,000 that I need to offset from with real estate depreciation. I'm going to go shopping for things that are a little different than what normal people might, right? I'm looking for projects like self-storage where a ton of it is qualified for accelerated depreciation, or manufactured homes where I can write off sometimes as much as 80% of that purchase in the first year. I'm looking at those because every dollar of deduction is worth 37 cents, right? Now you have the rest of us, and we might be looking at it saying, well, I don't have a bunch of passive income to offset. I just don't want to pay tax on my real estate. Okay, single families will do you just great. You could be buying those all day long. That you could just depreciate them normally. And then if you see one pop up and you say, oh, I got an extra $10,000 this year, you can actually go back and do what's called a cost segregation and accelerate depreciation on a property. And all you're doing is breaking the property into its components and writing off. It's usually about 30% of the property can be written off in 1 year. And you don't have to do it in the year you bought it. You can just pick it and we just offset that income. You just have to do that before October 15th if it's your property. If you do that, you're probably not paying any tax on your real estate. And
that's huge too. Cause I even know, even on like when I'm talking to my CPA, we'll do some cost seg just to get down to the lower tax brackets too.
Well, you're a real estate professional. So, so the big thing is if you cost seg and it creates a passive loss, you can use it and treat it as ordinary loss because you're a real estate professional. So you're in that one of the two exceptions, right? Now you can choose. Like there's a lot of flexibility there. I could cost seg a building and do no accelerated depreciation. When I cost seg, easiest way for people to understand this is like your carpeting. You shouldn't write carpet off over 27 and a half years, but 90% of the accountants do because your carpet's not going to last 27 and a half years. We all know it's going to last probably maybe 5 years. Well, that's what the IRS says it is. It's 5 years. So you would be writing off your carpet over 5 years. Well, how much is the carpet worth? Well, that's why you do a cost seg study. We got to break those out and say, here's what it's worth. All right, so I have $100,000 of carpet amongst my properties. I could write them off over 5 years. I get a $20,000 deduction a year. That may be good enough for me. And I say, hey, now I just eliminated the tax on my rental income. I'm good. I don't need to go crazy. But if it's not enough, you could actually, this year, we could depreciate and accelerate 80% of it. So let's say it's $100,000 of carpet across my properties. I could get an $80,000 deduction. Might be worth it for you, right? Maybe it's not, but you get to choose whether I'm going to take the bonus depreciation or if I'm just going to spread it out over 5 years. And it works the same for things like, 7-year property, 5-year property, 15-year property. Any of your land improvements are 15. So if you put in a driveway, you don't have to take all that depreciation now. So for example, a guy like you may not want to get into the 12% tax bracket. You may say, I have loans, I want to show a certain amount of income, and I'm comfortable paying up to 20%. So I'm going to keep myself at the $200,000 mark. Like you could literally position yourself where you're saying, this is how much income I'm willing to pay tax on an annual basis. And you actually can. You have a lot of flexibility, and people are sometimes shocked when they realize it's not an all or nothing proposition. You actually have a lot of choices in there, and be working with somebody who actually give you those choices.
Yeah, and that's what's awesome about real estate. It gives you a lot of flexibility.
Tons.
Okay, so let me ask you this little different topic. Like we were talking before the show, I saw one of your videos. So you deal with a lot of affluent people. And how do you, let me see, I wrote this down, how to not be a good defendant.
How to take that target off your back, right? How to make the target as small as possible. Because here's the reality. There's people that get sued all the time, especially in real estate. And what usually generates it is the landlord did something that was in the landlord's best interest, like remove a tenant. Usually you're bending over backwards trying to take care of these folks, but let's say you get a bad eviction and they go to their friend, they see a billboard and they see a lawyer, and the lawyer's called the Hammer, right? And so they go in to see the Hammer. There's actually a lawyer called the Hammer in Texas. It's actually really horrible. I'm going to go see the Hammer, and the Hammer says, let's see what Brian has. Oh, look, he has 15 other properties. He's a rich guy, and he's screwing you, that poor tenant. I bet you there was mold in that place. I bet you he violated a bunch of your rights. Let's see what we can think of. He's probably evicting you because of your color. Like, they're going to concoct something because they just saw that you're a rich guy. So the last thing you want to look like in a public record for the Hammer, right, is a rich guy or rich gal. You want to look like, hey, I have one property. There's really nothing to get. I can't see what Brian has. And it's really easy to do. You use a trust or LLC or a combination of the two, and you use states where you don't have where you don't have to provide the ownership information. So for trust, we could do this in every jurisdiction. In states, when you have an LLC, sometimes you're going to have to go to a jurisdiction like Wyoming and or Nevada. Those are the two big ones. But absolutely, positively, 100%. You can get your personal name off of any property in the United States, period, whether it's your home, whether it's rentals or whatnot. And the reason you do this is so that when somebody goes to see what Brian has, they don't see it. And then all these smart people out there are going to say, but I could get it in discovery. Yeah, but we're trying to prevent the frivolous lawsuit. We're trying to keep somebody from saying that's a good target. You want to look like almost like a homeless person, right? On paper. If they pull you up, they don't need to see that Brian has 6 companies and 20 properties and all this other stuff. That's none of their business. I can remove that from the public record if I want to. And I'll give you an example. And this is a real life, this was a client situation. And you could actually figure these facts out and what occurred if I gave you too many facts. But it was a building in a very liberal state that allowed for big lawsuits. And I'll leave it at that. The dad owned the property with the son. Son was structured through us. So we had it to where you couldn't see what else he owned. Dad had a very large firm, in a prominent firm, handling all of his stuff. And they did the old, let's get an umbrella policy and we'll do this. And they did these LLCs. They charged them 15 grand every time they did one, all that fun stuff. But all of his information was in a public record. And there was a very serious accident on this property. 2 people ended up amputations and like significant injuries, and they sued. And they were suing anybody and everybody they get their hands on. There was a a business in there. There was a valet service, and these guys, everybody's getting sued. They settled with our client right away for pennies on the dollar, like 25 grand. Because when they did the asset search, guess what they saw? Nothing, right? So I want you out. I want to keep the deep pocket. The dad, same property, same exposure, got drugged through a 5-year legal battle and ended up losing millions of dollars on it. The punchline here, the son was worth more than the dad.
That's crazy.
That's reality. If you can keep them from seeing what you got, there's a good chance that they're not going to come to take it. And somebody that's all the lawyers out there that are nursing, I'm sorry. I work with some of the best lawyers in the country, some of the biggest PI guys, and I talk to them. And the reason I talk to them, because I want to see what they're looking for. And yeah, I have the rule of like for $250,000, yeah, they'll get through anything, right? They'll start breaking these things down. But that's a lot of money that most people don't have to throw at a lawsuit.
So are you saying even, is it specific per state? Like you put your properties in an LLC, it's protected and like not showing up in your personal, or is it on all states?
In all states, I could figure that out. So see, people always think, well, my jurisdiction, I have to list the manager or the members. Okay, well then let's set up a Wyoming entity as the LLC and have it be a member-managed LLC in your state. So who's listed? Well, the Wyoming. Well, Wyoming, I can keep your name off it. I could be the only one that's on that entity as the incorporator. So I can keep your name out, and I could still be in your state. Well, no, I have to use 2 LLCs. You probably should be doing 2 LLCs anyway. Like you should never just be owning an LLC, because they can pierce that, or they can go after you and get to the entity that way. In most states, they'll allow you could take that away, because it's right in front of the judge, and the judge may say, hey, you know what? Brian owns this LLC, and, this person was harmed from that mold. We're going to pierce it, and then we're going to see what other LLC he owns, and we're going to give them those LLCs, and we're going to liquidate them. You need to remove that from the ability of happening, and you do that by putting another jurisdiction in play. That does not allow that. The sole and exclusive remedy is a charging order, which is basically I could get a lien against an LLC. That's their win, is a lien. They don't get anything for it. They don't get any cash. You're never going to pay them. And what happens is lawsuits go away quick. Like we've been doing this 25 years, and we work with tens of thousands. We've been through some knockdown, drag out lawsuits. We see what happens. If you want to be able to get out of these things and not spend 2 or 3 years of your life getting drug into court, this is how you do it. And this is how the rich people do it. I'm just being straight with you, is you got to be able to cut your losses. And it's not about, hey, if somebody sues me, I want to be able to, give them the middle finger and tell them they're not going to get anything. No, you want to be able to settle things and get on with your life. If you did something wrong, settle it out. But what you don't need is to have frivolous lawsuits take you out, or for someone to take your time simply because you have money and they don't.
Yeah, that's interesting stuff. And most people don't think about it that way. Because, people want to, like lawyers are on contingency. They're looking at, does this guy have money that we can even sue him for or not?
It's the calculation is, I have a claim. What is its best case scenario? What are my chances of getting that best case scenario? So let's say that I have a rear ender, and it's 90% certain that I'm liable, and there's $300,000 of damage, and there's insurance. Well, that's 100%, right? So, hey, let's settle for the insurance. Now let's say that, hey, but I could throw a few more claims on it, and I look at this guy and I say, well, I don't really see any other assets. I don't know whether I could collect. So they're going to stick to the 300. It's called being a master of pleadings. They're not going to try to go out. But if I see a case where the best case scenario, let's say it's a mold case in a state that loves mold, like you're in California or something, and they look at it and say, that's a multi-million-dollar case, I need to make sure that the next analysis is, what are my chances not only of winning, but what are my chances of collecting? So I may have a $2 million best case scenario, and I have a 50-50 chance. That gives me $1 million of settlement claim. Then that's exactly how they treat it. And then they look and say, but what are my chances of collecting? And if they don't see something that can be collected on, that $1 million claim all of a sudden becomes worthless. And that's what you want. You want them to walk away because it's worthless. It's not worth my time to roll the dice and to shake you down. But if I see assets and I see, there's 3 assets here with equity, shoot, our chances of collecting now are really high. So I may have a 50-50 chance on my case. It's $1 million. Now, all of a sudden, I have about an 80% chance of collecting. It's an $800,000 settlement. That's a painful settlement for a frivolous suit.
Yeah, that's interesting stuff there. Stuff people need to think about ahead of time, too.
If it's already occurring, it's too late. You can't go back and fix it. You got to look that way when whatever the occurrence is. So the best time to be doing it is before you start your activity. The second best time is while you're in your activity, but before any liabilities have popped up. That's
cool, man. Hey, Toby, if anyone wants to reach out to you or needs help with this stuff, what's the best way to connect?
I'll tell them to go to my YouTube channel. Just Google Toby Mathis. I have a huge following. I give out pretty practical, good advice. And I'm teaching because I do it. And I teach it because I don't have to get paid for it. Although we have a great firm and I love all that. But realistically, what I care about is that investors go in with their eyes open and that we knock off all this stuff of the billboard lawyers. I drive home, I see 26 billboards. If I go from the Strip, I live in Las Vegas. If I drive from the Strip to my house, I counted 26 personal injury billboards. That makes my stomach nauseous because, they're taking a contingency on this and there's such a huge appetite for it. I just want to make sure that people aren't a victim to that. We really want to end that type of stuff. And this is how you do it. Educate yourself, get your name off your things, and operate with a higher degree of peace of mind.
Yeah, cool, man. Hey, well, thanks for coming on. We appreciate you.
Hey, thanks.
Hey, everyone, thanks for listening. Yeah, we'll have a link to Toby's YouTube channel in the show notes also. Yeah, thanks for listening. Get out there, crush it, close some deals. We'll see you next time. Thanks, Toby.